The stock market has created more millionaires than any other investment vehicle in human history. People who invested $10,000 in the S&P 500 30 years ago now have over $170,000. People who invested $1,000 per month have over $1.7 million. And yet, most people are terrified of the stock market. They think it is gambling. They think you need a lot of money. They think it is only for rich people or finance experts. Every single one of those beliefs is completely wrong, and today I am going to prove it to you. This is the complete beginner's guide to the stock market. By the end of this video, you will understand exactly how it works and exactly what to do to start building wealth today. So what exactly is the stock market? Let me break it down in the simplest way possible. The stock market is a marketplace, just like Amazon or eBay, except instead of buying products, you are buying tiny pieces of companies. When a company like Apple wants to raise money to grow their business, they sell small pieces of the company to the public. These pieces are called shares or stocks. When you buy a share of Apple, you literally own a tiny piece of Apple as a business. And here is the beautiful part. When Apple makes more money and grows in value, your piece of Apple grows in value too. That is how ordinary people build extraordinary wealth through the stock market. The main stock market in the US is called the New York Stock Exchange, or the NASDAQ. These are the platforms where millions of buyers and sellers trade stocks every single day. Now, let me explain how it actually works in practice, because this is where most beginners get confused. The price of a stock goes up and down based on one simple thing: supply and demand. When more people want to buy a stock than sell it, the price goes up. When more people want to sell than buy, the price goes down. What drives people to buy or sell? Mostly company performance and investor sentiment. If Apple announces record profits, people rush to buy and the price goes up. If a company announces bad news, people sell and the price goes down. Short term, the market is driven by emotion and news, but long term, and this is the key insight, the market is driven by the actual growth of the economy and corporate profits. And over long periods of time, both of those things have always gone up. This is why long-term investing always beats short-term trading. You are not trying to predict daily price movements. You are simply participating in the long-term growth of the economy. Now, here is where beginners get confused. What is the difference between a stock, an ETF, and an index fund? Let me clear this up once and for all. A stock is a share of a single company. When you buy Tesla stock, you are betting everything on Tesla. If Tesla does well, you win big. If Tesla fails, you lose big. High risk, high reward. An ETF, or exchange traded fund, is a basket of multiple stocks bundled together. Instead of buying one company, you buy a collection of companies at once. Much lower risk because your money is spread across many businesses. An index fund is a specific type of ETF that tracks a market index, like the S&P 500. The S&P 500 is simply the 500 biggest companies in America: Apple, Microsoft, Amazon, Google, and 496 others. When you buy an S&P 500 index fund, you own tiny pieces of all 500 companies at once. For beginners, and honestly for most investors at any level, index funds are the clear winner. You get instant diversification, extremely low fees, and you automatically participate in the growth of the entire US economy. Warren Buffett himself has said index funds are the best investment for most people. One of the biggest fears beginners have is, what if the market crashes? What if I lose everything? This is a completely understandable fear. But here's what the data shows over 100 years of stock market history. The market has crashed in 1929, it crashed in 1987, it crashed in 2000, it crashed in 2008, it crashed in 2020. Every single time, without exception, it recovered and went on to reach new all-time highs. Why does the market always recover? Because the stock market represents the productive capacity of human civilization. As long as companies keep innovating, as long as people keep working and consuming, the economy grows and stock prices follow. The only way the stock market goes to zero permanently is if civilization itself collapses, and at that point you have much bigger problems than your investment portfolio. So, market crashes are not something to fear. They are actually opportunities to buy more at lower prices. The investors who panic and sell during crashes are the ones who lose money. The investors who hold and keep investing are the ones who build generational wealth. All right, so how do you actually build your first portfolio? Here is a simple beginner allocation that financial experts have used for decades. Put 80% of your investment money into a total market index fund. VOO, the Vanguard S&P 500 ETF, or FZROX on Fidelity are perfect choices. This is your core wealth-building engine. Put 15% into bonds. Bonds are less exciting, but they provide stability when the stock market drops. A simple bond ETF like BND works perfectly. The remaining 5% is optional. If you want to invest in individual stocks you believe in, Apple, Microsoft, whatever, keep it to 5% maximum. This way, if your pick goes wrong, it barely affects your overall portfolio. This simple 80-15-5 portfolio has beaten most professional fund managers over the past 30 years. It requires almost zero management and minimal fees. It is genuinely all most people ever need. Now, the part you have been waiting for: how do you actually buy your first stock or index fund? It is easier than you think. Step 1, open a brokerage account. Fidelity or Charles Schwab are my top recommendations. Both are free to open, zero minimum deposit, and zero commission trades. Takes about 10 minutes to set up. Step 2, fund your account. Link your bank account and transfer whatever amount you want to invest. Even $50 is enough to start. Step 3, search for VOO or FZROX in the search bar. Click Buy, enter the dollar amount you want to invest, confirm the order. That is genuinely it. You are now a stock market investor. The whole process takes less than 15 minutes from opening the account to making your first investment. Step 4, and this is the most important step, set up automatic monthly investments. Even $25 or $50 per month automatically invested is how ordinary people build extraordinary wealth over time. So let me give you your complete action plan to start today. 1, open your Fidelity or Schwab account right now. 2, deposit your first amount, any amount. 3, buy VOO or FZROX. 4, automate monthly contributions. That is the entire strategy. The stock market is not gambling. It is not just for the rich. It is not complicated. It is the single most powerful wealth-building tool available to ordinary people, and it has been proven over 100 years of history. The only thing standing between you and building real wealth is starting, and you can do that today. If this video helped you understand the stock market, hit that subscribe button right now. Every single week, I post videos breaking down investing and personal finance in the simplest way possible. Drop a comment below. What was the one thing about the stock market that confused you before watching this? I read and reply to every single comment. I'll see you in the next video. Keep building your wealth path.